Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield. Happy New Year, David.
Happy New Year. It's great to be back. Did you enjoy Christmas?
Yeah, it was all right. It was all right. Yeah, it was all right. How was yours?
Yeah, it was. You didn't buy any fine art over Christmas or did Santa bring you any fine art?
No, he didn't. No, actually, that you're referring back to, of course, our last podcast of 2024 with Amelie Serrado from Christie's when we talked all about the fine art market. No, I didn't get any for Christmas. I didn't buy any. I didn't even get a Birkin. Bit disappointed about that.
Oh dear. Well, I'm sorry to hear that. Maybe next year. And of course, markets were kind to us over Christmas as well.
Well, they were. Yeah. Exactly.
And by kind, I mean I still have slightly nightmarish thoughts on the Christmas where the US sold off massively just before New Year's Eve and then recovered in January. I think it was 18, and it's a repeat of that we all want to avoid.
Yeah, definitely. Well, on that note, we are going to be, before we come to the quick fire numbers round, we are going to be doing a little bit of an outlook for 2025. We're nailing our colours to the mast. To extend that metaphor, you're putting your head above the parapet. And we're not making predictions as such, but we're going to be talking about what we think is going to be kind of moving markets for 2025, or three things that we think are going to be moving markets, don't we? But before we get to that, quick fire numbers round. Do you want to go first? What's your number?
Yeah, let's have a quick fire numbers, shall we? I'm going to, I promise you, this will be the last time I talk about bananas on Need to Know. I think my quickfire numbers now have been three of them have been relating to bananas. It all started, of course, with a priceless piece of art, a piece of contemporary art with or conceptual art where a banana was taped to a wall and sold for millions of dollars. So my number, 3,810.
Okay.
Right. That is the number of people in a study under the University of Bath. A number of people that were monitored going into a supermarket buying bananas. Why was the University of Bath interested in what those 3,810 people did, you may ask?
Yeah,
well, there is a problem in supermarkets with single bananas. Who goes into a supermarket and buys a banana? And in fact, when you look at consumer behavior, consumers want bunches of bananas, which is one of the reasons that supermarkets put them in those bags to stop people splitting the bunch and buying these orphan bananas. Yeah. So what they were trying to do is understand if they could increase sales of single bananas. And what they did is they put next to the banana stand, the banana tray, a series of signs. Some of them had a banana with a sad face on them saying, "Please buy us, we're singles and we want to be bought as well." Another sign had a happy banana and the other sign was emotionally neutral. And they found that the sad banana, the sales of single bananas went from just over 2 an hour to an astonishing 3.2 an hour. So an increase of 58% with the sad sign. So the happy consumers don't like happy bananas, but they have sympathy for sad bananas. There you go.
People are pity buying bananas.
Exactly. I just thought it was a fascinating study. And I promise you, listeners, that's the last I'll talk about bananas.
Enough on bananas. Okay. All right.
What's your number? Take me away from bananas.
Well, I've been very boring and I've gone for a number that relates to one of our topics, and it's 35%.
Okay. Well, there is a number I saw recently, and if it's this, I'll be amazed. Is it a number about cars?
No.
Okay.
It's not about cars. It's the percentage of income that's saved in China. So your average Chinese worker saves 35% of their income. That compares to, what do you think it is in the US? I'm going to put you on the spot.
Well, very, very low. Single digits.
Yes, 7%.
There you go.
And this kind of comes to, well, we're going to be talking about China, but obviously that's one of the challenges in China is they need people to be spending more money and not saving, don't they?
Well, it's been a macroeconomic challenge for the world for over 3 decades. You know, excess savings in China and excess consumption in the US. And there's plenty of trade economics research and textbooks written on this. That's not intrinsically a problem. Like you shouldn't approach international trade as a zero-sum game. But it does explain a lot of the politics today and a lot of the imbalances today. And that it's all about extremes. You've got extreme excess saving in China and extreme excess consumption.
Okay. All right, then. So we're going to be talking about 3 things that we think are going to be sort of moving markets in 2025. What are those 3 very broad topics?
Well, all this comes with the proviso that there is no crystal ball in this business. But there's three things that are themes. It's more of a continuation, I think, of themes that have been running in 2024. So we're not here picking stocks, and we're not here saying this is going to be the next big thing. But the three things I think we need to watch this year. So we talked about AI last year, and I think let's talk about AI and where we are in this cycle. And I'm going to talk a bit about the S-curve, which I think is a good framework for sort of understanding where we are in this AI story. Then the second thing we absolutely have to talk about is China, which you've already alluded to. And with China, I think two things. It's about, are we going to see a change in Chinese economic outlook this year? We talked about stimulus last year. What's the likely outcome this year? And then the interaction with our third point, which is an incoming Republican administration, tariffs, and how that. I think with the third point on the Republicans, Trump, and tariffs, I'm going to try and give listeners a slightly different take on it. Okay, we talked a lot about tariffs, and the tariffs are inflationary and how complex global supply chains are, and they are incredibly complex. It's very difficult, I think, to understand a one-size-fits-all policy with tariffs. You have to look a lot at the individual supply chain and individual supply and demand curve of that particular good or product. But nonetheless, there is a potential outcome, I think, this year where tariffs might not be inflationary due to what happens in the foreign exchange markets. And I want to talk a bit about that, if that's okay.
Okay, good. All right, then. Well, let's kick off then with AI. Last year, it was all about NVIDIA and AI and how this was a massive boom. But was it a bubble? Concerns around, have we kind of peaked now with this technology? It's certainly as far as sort of prices of shares in companies that deal in this sort of side of business are concerned. So how do we see the AI narrative playing out in 2025? Is it going to evolve?
Yeah, and let's talk macro, because I'm not going to make a particular judgment on the valuation of NVIDIA and what that then implies for wide-scale adoption, because with that kind of valuation, it implies some significant AI adoption. I think what we'll talk about more, as you said just then, is about, is this the peak, or where are we in this journey? So last year, it wasn't just, remember when we were talking about AI in sort of March, April, it was the question of, is this just a frenzy? Is this just a bubble, or is it going to be backed up with anything? And I think you can now say, with 10 months of data under us, that AI adoption last year did increase exponentially. So it increased. Why? Because you had computational power increasing, the affordability of that power was actually really reasonable. You have widespread integration of AI into consumer products, GPT, Midjourney, Google Bard, all these things came to market. Everyone's now got an app on their phone. And at enterprise level, you've seen not only proof of concepts, but you've seen now rollouts into healthcare. There's diagnostic tools that run off AI that have reduced error rates by around a half. You've got finance, wide-scale adoption in finance in banks like our own that are using AI for fraud detection. And in investment banks, they are running products using AI for algorithmic trading. So it is becoming real. And if you sum all that up, the AI market value last year was around $207.9 billion. That's an estimate. But the point is, it's still expected to be around 500 billion by 2027. And if you look at a McKinsey report, which I read over Christmas, they reckon that 400 million jobs worldwide are going to be automated by AI, and they reckon that much of that is going to happen this year and in the next 2 years. Don't worry, Sarah, not just yet. I don't think we're going to be replaced by AI at this moment. But
not yet.
Give it a couple of months. But the point is that it's becoming real. So we know where we are, but the question is, well, where are we going, and what does this mean for 2025? And I thought about a framework for trying to understand where we are, and I think this idea of the S-curve, I think, is helpful here. Okay, so for those that aren't familiar with the S-curve, it's a way of representing how technology is generally adopted, and not just technology, many things. So by definition, it is the shape of an S. You have this rapid sort of advancement, then a kind of plateau, and then a sort of second advancement. And I think it's fair to say, or my contention would be, that AI has probably reached that sort of first inflection point. You've transitioned from early adoption to now widespread integration across sectors. But of course, it's that kind of flattening out part of the curve that's where you get your biggest challenges. Okay, and there are big challenges that AI needs to solve this year. Because remember, you've got to make money out of this.
Yeah. And
the big problem that the industry is grappling right now is really about scaling. Okay, so the point about the S curve is that, you know, there is this pretty common pattern with consumer tech products, and it either derives from a limitation in the underlying technology or market saturation, or occasionally both. Okay, so if you go back and look at tech adoption since 1900, you see the same S-curve pattern. The telephone, the PC, color TVs, digital cameras, you know, they all follow the same pattern. I mean, think about it this way. Anyone that's had an iPhone sort of 15 now, how much better is the battery today than what it was 10 years ago in the iPhone 7? The point is, it's not better at all. You know,
it's having to do much more, isn't it?
Yeah, exactly. And actually, you still run out of battery at the end of the day. And the point is that AI models kind of exhibit this same sort of scaling problem, right?
Right.
You know, the latest models that are coming out, right, which is about basically making AI models bigger, they get you another sort of, let's say, 10 to 15% improvement in some of the benchmarks they use. You have to wait another sort of 20 to 30 seconds to get that potential answer for the benchmarking exercise. So the point is that there is this big question out there that, are bigger models actually going to be better? And it's even more problematic because bigger models require more power. We talked a lot about the theme for which many of the investment banks and many analysts were talking about for last year, which was power and data centers. And you can have some fun out there with some absolutely bonkers calculations about training bigger AI models, right? So I don't want to get too technical for listeners, but there's this idea of something called a minimum loss line, okay, which is the point at which the model can achieve the best performance in its learning from the underlying data, okay? So you want a really low sort of minimum loss line. So my point is, if you took the entire world's energy production, the entire world's power generation today, and you put it into a thought experiment where we're going to train the world's most perfect AI model, the point is, even with the entire world's power output, you can't get these models with a minimum loss line below 1. So my point is that there is such a diminishing return on the quality of these models the bigger you try to make them. And the power demands are almost exponential as a consequence.
So then the answer then is small language models.
Exactly. And that is now what a lot of people are starting to pivot towards. And you see this. And you know, you look at the behavior of Google, you look at the behavior of Meta and Apple. I will go out on a limb and say they are not willing to pay the OpenAI tax of buying their AI model. They are actually trying to build their own. And if you look at where they're deploying resource capital, it's into building smaller, more nimble models that basically trickle down from bigger models. And it takes far less power to train them. They're far more cost efficient to run. And I think now we're in this sort of efficiency game.
Yeah. Explain then, just for those that don't know, the difference between a large language model and a small language model in very simple terms.
Well, it's really about, well, there's some complicated sort of, obviously, software engineering behind it, but it's just about the scale of the data required to train them. Okay, so there was an idea not that long ago that you just needed to make models bigger and get more data in them. Now, it's a little bit cynical, but it is realistic to suggest that actually we've already trained some of these models on all the publicly available data there is. There isn't just no high quality data out there anymore to train more models. So the smaller models kind of, they're just more focused and targeted to specific tasks, and they trickle down from bigger models. And that's what I think, well, that's where I think we're going this year. Okay, so because the power demands, the resource demands, and the costs of large models are just, the economics just don't look good. So I think that's the key, smaller deployable models. So what does that mean for markets? What does that actually mean for?
Yeah.
So I thought about this in the context of investment, not just the fun topic of AI. I think this sets up quite an interesting story because everyone knows that energy demand is going up, but there are actually very few plays to get exposure to that theme of rising energy demand. Okay, so what's happened is everyone's just crowded into Magnificent Seven stocks. So those big, giant tech firms that are playing with AI, and that's what's kind of defined this rally over the last year. Now, there is some interesting consequences for markets when that happens. When the market gets very crowded into, say, 7 stocks, there's this mechanical effect where you actually drive down realized correlation and implied volatility. So listeners all know that as best represented as VIX, as the VIX index.
Yeah.
Okay, so you kind of compress volatility again through this crowding effect, and that's the situation we've had for some time now. With a notable spike in August last year. But my point is that that then fuels dispersion trades and other kind of trades that rely on low volatility. So we could see more of that next year if this crowding effect continues. So I think this year there's either going to be some cracks appear in power grids, cooling systems, maybe some geographical kind of arbitrage, because remember what we talked about before, there are just some regions that just aren't playing with AI, some countries, right? So you could see some cracks appear there, or you perhaps might see some other ways of investors trying to play this trend, but I'm skeptical, right? Utilities, you might think, right, power generation, I want to play utilities in 2025, but is that just rates exposure? Because remember, utility firms carry a lot of debt, they're very exposed to interest rates. Is that actually just a rates trade, or is it actually a pure AI trade? Don't know. Data center REITs, which are now on the market, sort of real estate investment trust, that could just be the same story. And then you've got infrastructure funds as well, but they have too much exposure to other things. So I think the story for AI this year, I think, is about now that middle part of the S curve, overcoming the scaling problem, making models more efficient, really getting into the profitability of individual use cases. From an investor point of view, I'm not sure I can see the appetite for Mag 7 stock decreasing in the short term. So we're going to have to live with this kind of crowding effect for some time, I think.
And certainly if we look at companies like NVIDIA, they seem to be shifting their focus more. They're certainly investing in a lot of startups, aren't they, in the AI sector? So they're diversifying, and they're looking at, I think a lot of their focus for 2025 is going to be robotics, isn't it? So physical AI is the other big area, which perhaps hasn't really quite sort of reached its potential yet. I mean, AI hasn't reached its potential yet.
Yeah, look, I think that's fair. And NVIDIA have got a long history of being very capable at anticipating changes and trends. And I think what they're recognizing is if this now shifts to a more efficient business model, so we overcome the scaling problem with these smaller language models that don't require as much training, well, then that means there's probably less demand for NVIDIA's bread and butter business, which is chip demand. So it makes complete sense they would pivot towards other diversified sources of revenue. Absolutely.
It looks like that narrative has got a little bit further to run yet.
Oh, absolutely. I remember when I talked about having optionality in trades and not confining your trades to a particular time box, this couldn't be more important. No one knows how long that middle stretch of the S curve could be. Yeah. Could be 3, 4, 5 years. Remember, it took us about 10 years to get from internet to iPhone. And by internet, I mean retail adoption of the internet to the iPhone.
Yeah, okay. Yeah. So we won't know until we've gone past it, will we?
Well, unfortunately not. They're very difficult. These kind of technological leaps are extremely difficult to predict.
Yeah, okay. So, well, that's AI. Next up, China, which is... well, and this kind of leads into it will kind of connect into our third point. But China, obviously, we saw a lot of sort of promises of the government was going to be investing in the economy. They actually had a pretty good year last year in markets, didn't they? I think the CSI 300 was up 14.7% last year. Not bad. It's had a bit of a weak start to 2025.
Incredibly volatile. And And yeah, it's a trade at the moment that looks like it's based on stimulus promise more than economic fundamentals. So maybe we should bring that to life then with the numbers, because you can actually remember the point that I made last year, which is if you want exposure to economic growth and the ability to translate economic growth into ultimately shareholder returns, then China is remarkably inefficient with that conversion of economic growth into shareholder returns. As a shareholder, you tend not to get rewarded over the long term as much as you do in other markets, and particularly in the US. So a quick recap for listeners that perhaps didn't listen to our China podcast a couple of months ago. Chinese export prices have basically been steadily falling over the last decade, basically. So, I mean, think about the price of a solar panel or, you know, a high-tech Chinese export. They've been falling. The export volumes have been growing in a much faster pace than the dollar value of those same exports. Okay, so on the other side of the equation, import volumes have collapsed, okay, and continued to shrink. So you've got this situation where export volumes are up around year on year, around 13%, and import volumes are only up around 2%. Okay, so exports are still about 20% of China's GDP. So if you do some rough maths, that implies that the sort of roughly 10% gap between imports and exports means that China's net exports are about 2% of its GDP growth. So they're the majority still of China's GDP growth. Why is that important? Well, it's important because China is still very export dependent in a world that we're going into, which is potentially a world with high friction of trade, geopolitical risks. And we talked a lot about in the China podcast about the need to create domestic demand in China. So if you look at the numbers show that China is still an export economy, and the Chinese bond market is probably the only major bond market in the world at the time of recording, with yields falling, not just falling, but the bond market is basically saying China's in deflation. It's going into this. Now we're going to get slightly into journalistic sort of hyperbole, but we're going into Japanification of China. I'm not quite there yet in terms of that's the prognosis, but there's certainly the bond market signaling that China's in deflationary spiral. Now, this is the lesson. The lesson is the same one that we talked about on the China podcast, that you need to break that spiral with big fiscal stimulus, generate domestic demand. And I think we spent a lot of 2024 waiting for that. And I think in 2025, I'm not sure it's going to be very much different. I mean, the sentiment is there, that the intent is there, but I don't think it's a game changer yet. And I think if you go and look at China's fiscal stimulus in recent years, if you go and look at fiscal stimulus between 2020 and 2022, and that's the period, remember, when the real estate bubble really imploded in China. The budget deficit was actually contracting as a percentage of GDP. So basically, you know, since 2022, it's barely moved upwards. And you've had this situation where, you know, China has actually been quite fiscally constrained over the last few years at a period where it probably doesn't want to be. And while you've had this massive trade surplus going on, so this export-driven economic model, you've seen the Chinese yuan depreciating, right? It's depreciated about 15% since its late 2021 high. And that just further boosts exports, right? So this is really relevant when we think about 2025 and China and the US, because these two countries have this almost symbiotic relationship, right? When I talk about global excess savings and global excess consumption, I'm really talking about excess savings in China and excess consumption in the US. So you can't solve one without the other. I think so for 2025, it's all about stimulus and fiscal stimulus, and I'm skeptical that we're going to get that. That's my crystal ball. Okay,
but also the Chinese consumers got to play a part, haven't they? Because they've got to stop saving a bit less and spending a bit more.
Yeah, but you know, you sort of this massive current account imbalance ultimately translates into excess domestic savings, and if the currency keeps depreciating, then if you're a Chinese sort of middle class individual and you're accumulating savings, your tendency is going to be to try and get those out of your domestic currencies. Probably going to buy things like gold, because there are massive capital controls in China, and actually getting money into overseas shares or overseas real assets is really difficult.
And also where you lack a safety net within the economy for those that are unable to work or through ill health or whatever, you're going to only encourage people to save more, because there's going to be a fear of, well, what happens if I lose my job, or what happens if something happens to me and I can't work? So there's no safety net there to protect people in China. So that's going to incentivize more saving and less spending, isn't it?
Yeah, I mean, look, the government on the other side of the sort of balance sheet here has a huge amount of foreign exchange reserves, which is accumulated due to this current account surplus. So there's a number of ways they could be deployed. They can be deployed into the domestic economy to provide that kind of safety net, or they could be used in foreign exchange intervention, which I think is what we're going to come to when we talk about tariffs, actually. So can I segue into that? Because these two stories, China and tariffs and Trump, are very interlinked.
I was going to say, before we get to that, I suppose the thing to watch for in China is, I believe in March, we've got sort of one of the big meetings for the Chinese government, where they will unveil their economic policy agenda for the year ahead. And I guess that's what everybody will be watching, to see if there are any more announcements about stimulus, what their expectations are for GDP growth for the coming year.
Yeah, I'm always, although I'm a little bit skeptical about stimulus, listeners, I'm going to get myself out of jail by saying that there is only really sort of one G7 scale economy in the world that can pivot policy so rapidly that, with minimal sort of political impediments, and that's China. So what I mean there is that it wouldn't be a huge surprise. It would be a shock, but it wouldn't be a huge surprise if overnight almost you did get that fiscal stimulus, you did get helicopter money, you did get the kind of direct intervention that everyone has been calling for, because the actual political barriers to delivering that in China are actually very low, because in many respects, banks' balance sheets and the state's balance sheets are kind of the same thing. I know that's a sort of slightly flippant remark, but your ability to directly impact the real economy as a policymaker, well, it's direct. Whereas in a Western democracy, the transmission mechanism is more, there's more intermediaries, and it can be more diffuse, and you're relying on the private sector very much to implement that policy. Whereas in China, you can kind of do it directly.
So if the will is there, they have the technology to do it, or they have the wherewithal to do it.
Yeah, and I think it comes down to this bilateral relationship with the US, really, because it will come back to, for me, it will come down to the currency and what the Chinese. I think that's my first. That will be my first sort of tripwire, my lead indicator to the Chinese government's willingness to really do direct intervention in the real economy. We'll come on to that with tariffs.
Well, exactly, which then brings us to the third point, this obviously is perhaps potentially a big hurdle for China, is New Year, new president.
20th of January, new president. But yeah, you're absolutely right. And I've spent too much time talking and thinking about tariffs over the last couple of months. I think the recent sort of musings about Canada, Greenland, the Panama Canal, and of course, yesterday, the renaming of the Gulf of Mexico to the Gulf of America sort of show you that there's going to be a different geopolitical calculus over the coming 4 years. But with tariffs, I've been thinking about, well, what's a non-consensus view that we could discuss and we could explore? Okay, and I think
tariffs are bad and they're inflationary, and they encourage countries to sort of retaliate. They're a bad thing.
That is true. It is true as a generalization, but like I said about supply chains earlier, you have to really get into the individual supply chain and then the demand and supply curve of the individual product, because for some products, the shift is just a parallel shift in a deflationary trend. For other products, it's where there's no sort of substitution effect. It can be an outright inflationary impact. It's complicated. It's really, really complicated. But I've been thinking about, I think one of the big stories for this year, which wasn't in my 3 topics, because we'll come back to it, I think, is going to be about currency markets and about dollar strength. So what if we had tariffs this year, but they didn't have a massive effect on inflation? but they probably would be negative for economic growth. So this isn't a core scenario that the market is positioned for, because the market is still, well, in fact, some analysts are suggesting 0% chance of a US recession this year. And most analysts will accept that tariffs in some way, shape, or form are inflationary. But how would you get non-inflationary tariffs? Well, I think it's all about currency. So if you go and look at Trump's last term, you had an effective tariff rate for Chinese imports of about 18%. But at the same time, the dollar appreciated by about 14% against the Chinese yuan. So it had a muted effect because the currency kind of got you out of that tariff problem. Now, tariffs are negative for business sentiment, investment growth. If you're a US exporter, clearly a strong dollar is problematic, okay? And we know that a strong dollar is a drag on US earnings growth, okay? And in a similar way that UK companies have overseas earnings, US companies generate around 60% of their earnings from non-dollar earnings. So if you go back and look at the chart from 96 to 2001 and those periods where the dollar was strong, or 21 to 23 in this century, you see that effect. So I think it all depends on whether the tariffs hit countries where those countries might devalue their exchange rates. Or in the case of China, they could just let their currency drift down and not do a devaluation as such, but just not intervene. So I think there's a number of options this year. And I think this is where it comes back to China, right? So China could intervene in the FX markets this year. They could use these massive foreign exchange reserves to bolster the currency and basically export some inflation pain to the US.
Yeah.
Or they could just let their currency drift down and use workarounds. And that's kind of what we saw last time. Remember, we talked a lot on the pod about the factors of production in China shifting either to countries that are closer to America or countries that are neighbors of China. So in the case of sort of car manufacturing, some Chinese companies and component companies have relocated in Mexico within the North American free trade area. Or equally, if you go and look at trade statistics, you see a remarkable increase in bilateral trade between the US and countries like Vietnam, Korea, Thailand, Malaysia. These are just kind of proxies for China exporting through those countries. So I think it's the currency that's going to dictate this.
And China has a huge footprint in South America, doesn't it? And they've got this mega port in Peru. So they've got, and presumably, without sort of straying into politics, I mean, there are some Latin American governments that are probably quite in favor of China. I mean, not all of them, but there'll be some that will be very supportive of China.
Yeah, I think this is one of the big questions for this year, particularly. I mean, Latin America is a really good example. You've had a port which has been specifically built in Peru to handle China's insatiable demand for natural resources. So if you consider that in Latin America, you mine nearly half of the world's copper, and you've had a port pretty much built in Peru for $1.3 billion that is entirely set up to bolster China's access to Latin America's resources. Now, the people that sort of surround the incoming Republican administration have said quite openly on record that they want to impose tariffs on ports like that, you know, and quite substantial tariffs. And I think you've got a very complex interplay here between US sort of geopolitics and relations with Latin American countries, trade tensions between the US and China. And then, you know, I'm sort of tongue-in-cheek here saying that one of the principal advisors now around the incoming president, the president-elect, is CEO of one of the world's largest EV makers.
Yeah.
Okay. Now, if you consider the kind of components that go into a Tesla, they come from a huge list of countries globally, and tariffs would be the worst thing for Tesla you can imagine. So I think you're right, absolutely right to raise Latin America, because it's big in this geopolitical tug of war.
Yeah, and the fact is, we don't know until he is inaugurated on the 20th of January what he's going to do. There's lots of rhetoric at the moment, and I've seen a few people sort of saying, well, this is very much his negotiating tactic. You go in really bold and really strong, and then you come down from that, but you go in really high. So this sort of talk about sort of 60% tariffs on China. I mean, some people are saying that's never going to happen. We're going to come down from that. But the fact is, we don't know until he's inaugurated what he decides to do.
We don't, and I think it's right to say on the one hand this, on the other hand that. I mean, on the one hand, it could just be rhetoric and not reality. On the other hand, he's got 4 years now. He's not going to get second term. So, and the people the Republicans are surrounding the executive branch with are people that are likely to just implement policy and not, question it. So, I think what we could say for 2025 is yes, you don't know, but the bond market appears to be pricing in inflation. So I will go out on a limb and say that the bond market actually looks quite interesting going into 2025. And I know that, again, wasn't one of our three topics, but if you look at the bond market, certainly the sort of short end of the curve, it's very hawkish right now. There's actually a very high implied probability. If you go and look at derivative markets, you see a very high implied probability that the Fed is likely to even hike again. Yeah. Okay. I don't think that's going to happen, but the point is that some of those estimates are up at 40%. So it's meant that you've got a very hawkish front end of the bond market. The Fed funds rate is at 4.25%, and the 10-year is around 4.6. So I think bonds actually look quite interesting if you don't get some of these sort of inflationary outcomes. And in fact, if you go and look at some real statistics about inflation, looking at sort of Z scores, you can see that inflation all over the world is coming down. I know we get hung up on the sticky parts of services and little spikes along the way, but the overall trend is still disinflation. It's just slow. So I think the bond market looks interesting, actually. And you're right, we don't know, but I still think that you're incredibly hawkish if you think that the Fed's going to hike from here.
Yeah, I mean, certainly expectations are we're going to get a pause, aren't we, in rate cuts as far as the Fed is concerned for the next few months. And as you say, I've also seen a few people suggesting that we might even get hikes. Ultimately, whatever happens, they've got a new president in the US, and it will have an impact on markets, whatever he does.
I think it will have an impact in the short term, just on volatility and sentiment. I think in the long term, remember, policy, like you've got to enact law, okay? And law requires Congress to pass law that gets ratified by the president. Otherwise, you're just in a situation where you write executive orders and they disappear every 4 years. And one of the big criticisms from the business community has been that we need just certainty because we need laws to be passed, not just executive orders. So it's going to be about building a consensus. And when you build a consensus, that's when you start compromising and then you don't get the kind of extreme outcomes. But my point on the bond market, though, is that I think that it's looking very pessimistic about inflation. And I actually think the underlying macro is probably more optimistic. So with yields where they are, I think bonds look interesting.
Okay. So what we're going to be watching this year, amongst many other things, the AI boom, how that evolves in 2025, and this sort of shift perhaps to these more specialized new small language models, plus physical AI. China, what happens in China? Do we get more stimulus? How do they react to tariffs, if tariffs are introduced by the US, or what level they're introduced? And then the broader impact on markets of the new president, what he decides to do, how much is executive order, how much is actually law, and how that plays out. And as you say, the bond market at the moment, we've argued that tariffs may or may not be inflationary, depending on what happens with the currency, but certainly bond market's a little bit pessimistic.
That's exactly right. And I think the key this year is understanding the dollar and understanding dollar strength. And then the interplay between that and countries that have tariffs levied on them, whether those countries devalue or not. That's going to be absolute key this year. Remember, listeners, we are living through quite a peculiar time of dollar strength right now. Remember that one of the reasons, not the only reason, but one of the reasons why the dollar is a global reserve currency is it's generally quite weak. generally very strong currencies and not good global reserve currencies. But anyway, I think I'm not forecasting a decline in the dollar, even though it's been very volatile over the last couple of weeks. I think, though, that it's key to a lot of things this year.
Okay. On that note, a reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you, David, for joining me today. Thank you for listening. If you want to check out previous episodes, if you're not already subscribing to us on Spotify and Apple, please do. Our last episode of 2024, which we mentioned earlier, was with Amelie Serrado from Christie's, where we talked about the art market in 2024 and the outlook for 2025. And yes, we did talk about bananas. It was very good, very interesting. It's always lovely to have Amelie on. Until next time on Need to Know, bye for now.